Imagine waking up in 2026 and realizing your money made money while you slept. No stress, no guessing, no gambling, just smart investing that compounds quietly in the background. And in this video, I'm going to break down the best investments for 2026, from safe, low-risk options to high-growth opportunities that could multiply your wealth. If you want more deep financial breakdowns like this, subscribe right now, because this channel is all about turning knowledge into income and passive wealth. And by the end of this video, you'll know exactly where to put your money based on your risk level, your income, and your long-term goals. So let's start with the safest option on the planet: high-yield savings accounts, which in 2026 are expected to offer around 4 to 6% annual interest depending on inflation and central bank policies, meaning if you deposit $10,000, you could earn around $400 to $600 per year with almost zero risk. And while this won't make you rich, it's perfect for emergency funds and short-term savings because your money is liquid, insured, and stable. Next up are certificates of deposit, or CDs, which are basically savings accounts with a lock-in period. So if you lock $10,000 for 3 years at 5.5% interest, you'll earn around $1,740 in interest by the end. But the downside is you can't withdraw early without penalties, making CDs great for disciplined investors who want guaranteed returns. Now moving into government bonds. These are loans you give to governments like US Treasuries or EU bonds, and in 2026, yields might hover around 3 to 5%, so a $10,000 investment could return $300 to $500 per year with extremely low risk, making them ideal for conservative investors and retirees. But if you want higher returns, corporate bonds come next, where companies borrow your money and pay you interest. And these can yield anywhere from 4 to 9%, depending on risk, meaning a $10,000 investment at 7% could earn $700 per year, but with higher risk if the company fails, which is why diversification matters. Then we have money market funds, which invest in short-term debt and typically yield slightly more than savings accounts, around 3.5 to 5%. So again, a $10,000 investment might earn around $350 to $500 annually while maintaining high liquidity, making them perfect for parking cash temporarily. Now stepping into growth territory, we have mutual funds, which pool money from investors and invest in stocks, bonds, or mixed assets. And historically, mutual funds can average around 6 to 10% annually, meaning if you invest $10,000 and earn 8% per year for 20 years, you could end up with around $46,000 due to compound interest, which is where wealth really starts to snowball. But even more powerful for most modern investors are index funds, which track markets like the S&P 500. And historically have averaged around 8 to 12% annually. So if you invest $10,000 at 10% per year for 30 years, you'd end up with about $174,000. And that's without picking a single stock, just buying the market. And then we have ETFs, or exchange-traded funds, which are similar to index funds but traded like stocks. And they offer flexibility, low fees, and massive diversification, making them one of the best investments for beginners in 2026. And if an ETF averages 9% annually, your $10,000 could become around $56,000 in 25 years. Now, for those who love income, dividend stocks are incredibly powerful because they pay you regularly while also growing in value. And if you buy $10,000 worth of dividend stocks yielding 4%, you'll earn $400 per year. But if dividends grow at 6% annually and you reinvest them, you could double your money in around 12 years, thanks to compounding. But of course, stocks themselves are where massive wealth is created. And while risky, stocks historically average around 10 to 15% annually, meaning $10,000 invested in stocks at 12% per year for 25 years could become around $170,000. And if you pick the right growth stocks, the returns can be life-changing, but with volatility and emotional discipline required. And finally, gold, the timeless hedge against inflation and economic uncertainty, which doesn't produce income but preserves wealth. And if inflation averages 3% and gold rises similarly, your purchasing power stays protected, making gold a smart diversification tool rather than a growth engine. And the key takeaway for 2026 is this: safe assets protect your money, growth assets multiply your money, and smart diversification balances risk and reward. So a balanced portfolio might look like 20% savings and bonds, 40% index funds and ETFs, 30% stocks and dividend stocks, and 10% gold or alternative assets. And if you invested $10,000 with an average return of 9% annually, you could grow it to about $23,000 in 10 years, $54,000 in 20 years, and $128,000 in 30 years. And that is how ordinary people quietly become wealthy over time. And before you go, here's the most important thing. The best investment in 2026 is not timing the market, it's time in the market. Because every year you delay investing costs you tens of thousands in lost compound interest. So if this video helped you, smash the like button, subscribe for more wealth-building content, and comment below what you're investing in for 2026. Because your future self will thank you for starting today. And I'll see you in the next video, where we break down how to build a portfolio step by step with just $100. And here's something most people don't realize about investing in 2026. The global financial system is evolving faster than ever before, driven by AI trading, demographic shifts, and central bank digital currencies, which means the assets you choose today could behave very differently than they did in the past. For example, high-yield savings accounts are no longer just boring bank products. Some fintech platforms now use AI-driven liquidity management to offer competitive yields that dynamically adjust with inflation. Meaning your interest rate could automatically increase when inflation spikes, protecting your purchasing power in real time. And certificates of deposit are also evolving, with some banks experimenting with flexible CDs that allow partial withdrawals or variable interest rates tied to market benchmarks, blending safety with adaptability. And when it comes to government bonds, a fascinating fact is that global bond markets are now larger than global stock markets, with trillions of dollars flowing into sovereign debt during economic uncertainty. And historically, during recessions, government bonds often rise in value as stocks fall, making them one of the best hedges against market crashes. While corporate bonds tell a different story. Investment-grade corporate bonds have historically defaulted less than 0.1% per year, but high-yield junk bonds can offer massive returns with default rates closer to 4%, meaning diversification across bond grades can dramatically change your risk profile. And money market funds are becoming the backbone of institutional finance, with trillions parked in them daily by hedge funds, corporations, and even governments, acting as the plumbing of the global financial system, which is why regulators monitor them closely to prevent liquidity crises. And when you move into mutual funds, one intriguing fact is that over 80% of actively managed mutual funds fail to beat their benchmark index over long periods, which is why passive investing has exploded in popularity, and index funds now control a massive portion of global equities. With some analysts warning that a handful of index fund providers hold significant voting power in major corporations, subtly shaping the future of global business, and ETFs are even more disruptive, with some ETFs now tracking AI companies, robotics firms, clean energy sectors, and even space exploration stocks, allowing everyday investors to own slices of futuristic industries with a single click. And dividend stocks have a fascinating psychological advantage. They provide tangible cash flow, which reduces emotional panic during market downturns. And historically, dividends have contributed over 40% of total stock market returns over the last century, meaning that reinvesting dividends can dramatically accelerate wealth building. And speaking of stocks, here's a mind-blowing fact. If you invested just $10,000 in the S&P 500 in 1980, it would be worth over $1 million today with dividends reinvested, showing the raw power of compounding and patience. And yet, only a tiny percentage of people stay invested. For decades, fear and emotional decision-making have heavily influenced how people invest. This makes psychology arguably the most important factor in investing, as emotions can drive markets just as much as economic fundamentals. Gold, often seen as old-fashioned, is now being accumulated by central banks at record rates. This is especially true in countries reducing dependence on the US dollar, making gold not just a hedge against inflation, but also a critical geopolitical asset. If you zoom out, one of the most intriguing trends for 2026 is the rise of barbell portfolios. Investors combine ultra-safe assets like bonds and savings with ultra-high growth assets like AI stocks and biotech, capturing upside while protecting against downside. Another emerging trend is fractional investing, which allows people to buy tiny pieces of expensive stocks, bonds, and ETFs with just a few dollars. This innovation is democratizing wealth creation like never before, making the financial markets accessible to almost anyone. Here's a powerful calculation. Investing $500 per month at an average 9% annual return for 30 years yields over $800,000. But delaying for 10 years and investing for 20 years results in less than half that, proving that time beats timing every single time. In 2026, AI-powered robo-advisors are transforming investing by automatically rebalancing portfolios, harvesting tax losses, and optimizing asset allocation based on your risk tolerance. This means even beginners can invest like professionals with minimal effort. One of the most intriguing macro trends is demographics. Aging populations in Europe and Japan increase demand for bonds and dividend stocks, while younger populations in emerging markets drive demand for growth stocks and crypto-adjacent tech companies, creating global capital flows shaping returns for decades. Understanding these forces gives you an unfair advantage as an investor. Investing is not just about numbers. It's about predicting where the world is going and positioning your money accordingly for future opportunities and security.